To start day trading today is to step into the loudest, most competitive market environment ever created. Most beginners fail, not because trading is mathematically impossible, but because they build their foundation on Discord alerts, overlapping indicators, and wild guesswork. We can begin to simplify this environment by removing the choice of what to trade. For this model, we trade exactly one market, gold. Before you even look for a setup, your workspace needs strict parameters. Your chart is set exclusively to gold. Your time zone is locked to UTC-5 to match New York time. Finally, apply the Sessions FX indicator to visually block out the trading sessions. By stripping away these variables, we eliminate the emotional urge to jump between random charts. We stop gambling with better software and start relying on a strict mechanical foundation driven by statistical probability. The discipline continues with our timing. We only start looking at the market at exactly 9:30 a.m. Eastern Standard Time, the moment the New York market opens for the day. Start on the 15-minute time frame. Look at where the price is currently sitting, and draw a horizontal line at the closest recent swing high, and another at the closest recent swing low. Whatever the market was doing in the pre-market hours before 9:30, whether it was trending or trading sideways, does not matter. For the purposes of this strategy, that is noise. Now we wait for a liquidity sweep. We watch the chart until the price breaks through either our established high line or our established low line. Warning tone: do not execute a trade when this line breaks. Sweeping that high or low provides us with context, but it is not an entry signal. You must hold your fire. Waiting for this sweep means reacting to the market's actual momentum as it happens, rather than trying to predict it before the bell rings. The moment that 15-minute sweep occurs, your next mechanical action is to immediately drop down to the 1-minute chart. This graphic shows a fair value gap. It is a specific 3-candle pattern indicating an imbalance in price action. The gap exists in the empty space between the bottom wick of the first candle and the top wick of the third candle. Location is critical here. To be valid, this gap must form inside the exact downward or upward leg of price action that just swept your 15-minute high or low. Any gap that forms outside of this relevant displacement leg is invalid. When placed correctly within that sweep leg, the gap acts as a footprint of institutional order flow. It shows us where the market has moved with enough speed to leave an imbalance behind. We have our setup, but we still need our execution trigger. For that, we wait to see if the market fails to maintain its current direction and reverses back into our established gap. To confirm that reversal, we need to see an inverse fair value gap. As shown in this animation, a 1-minute candle must form and close its solid body firmly on the opposite side of the gap zone we highlighted. Wicks piercing the zone do not count. For the momentum shift to be confirmed, we need a full, solid candle body to close cleanly past the gap. The precise second that 1-minute candle body closes and validates the inverse gap, you execute a market order. This sequence indicates that the initial liquidity sweep has failed to attract further volume in that direction. By reacting to this closure, we align our entry with the newly confirmed momentum. This visual maps out our risk structure. Immediately after entering, place your stop loss directly beyond the recent swing point of the entry formation. That defines our total risk. Next, set your take profit to exactly 2R. This means the potential reward is strictly double the initial risk you just established. Now we manage the open trade. Measure the halfway point to your target, which represents a 1-to-1 risk-to-reward ratio, and set an alert at that exact price level. The moment price crosses that 1R milestone, you manually move your stop loss up to your exact entry price. Advancing the stop to break even removes the downside risk from the table. The remainder of the trade becomes a stress-free mathematical event. At this stage, your execution is fully automated. The trade will either run up to hit your 2R target for a win, or it will pull back and tag you out at break even. Keep in mind, this specific sequence will not appear every morning. If 9:30 comes and goes without the model presenting itself, the only move that preserves your capital is to walk away and do nothing. Before risking any capital, backtest this exact mechanical setup for 1 full month. Collect the data and verify that the rules yield a positive result over multiple sessions. Long-term success is not about chasing a flawless win rate. It comes from trusting a positive expectancy over a large sample size, cutting out the noise, and executing with strict, unwavering consistency.